Good afternoon, everybody. This is Brian Hartman. I am at Pharus Global headquarters in Pharus Plaza. We're located at 1859 Southeast Port St. Lucie Boulevard in Port St. Lucie, Florida, and happy to be with all of you tonight. Come by and visit us. We've got donuts and occasional coffee once in a while. PharusGlobal.com. We are now 8 companies under one roof, an ecosystem of businesses here to help businesses scale and grow, maximize their value, and then eventually bring them to exit. So we help them find buyers so they can ride off into the sunset or do whatever it is they're looking forward to doing after building a fantastic business. We do everything from outsourced managed services to commercial and residential mortgages. We do commercial residential real estate. We do medical practice management, billing, coding, credentialing, IT services. We also have a full service insurance agency doing personal and commercial lines of insurance. So everything we can do to help businesses, real estate investment firms, and medical and dental practices grow. We're here to help. You can see us at PharusGlobal.com to check that all out. And today is episode number 40. I didn't even get to share that with Jay yet. Episode number 40. So he is part of history in the making. We're featuring Jay Spindel of INTE Securities, and Jay will be presenting Venture Debt, the underutilized security. I'm excited to hear about it as well. So Jay Spindel's been a Wall Street executive more than 3 decades. He's managed several boutique hedge funds and broker dealers over the course of his career. He received a bachelor's degree from the State University of New York at Albany, go New York, with a double concentration in finance and management. He's currently licensed at a registered FINRA broker dealer, INTE Securities, LLC. For the past several years, he's cultivated relationships for companies seeking venture debt and bridge financing, mainly in the healthcare and technology fields. And many of these financings have resulted in those companies ultimately getting purchased. So you can see where the collaboration is between us. And I'm looking forward to hearing some more of that. So let's welcome Mr. Jay Spindel.
Thanks for having me, Brian.
Hey there, Jay. I'm glad that you could make it. I'm looking forward. I'm excited about all of this.
I'm excited to be part of episode 40. Congratulations on that milestone.
It's a milestone.
Something to be proud of. That's great.
Yeah, it's exciting. We're getting there for sure. And what better than to have a New Yorker on the 40th show? Love it. So you're in what part of New York are you in, Jay?
I'm in the Upper East Side of Manhattan right now.
Awesome. And I understand you said you're getting some warm weather tomorrow. You're getting out of the frozen tundra?
Hasn't been frozen tundra, but it's been a little volatile. It's kind of like the market. It'll be 65 tomorrow, so it'll be a nice day to enjoy outside.
I love that little spin on the market and the volatility. Yeah, that was pretty cool. So I know that we're excited. Our viewers are going to be excited to hear more about venture debt and what you've accomplished with that. So maybe we could start off by just simply, what is venture debt?
Sure, happy to explain. So venture debt is debt used on venture capitalized companies. The venture capitalists generally invest equity, sometimes a combination of equity and debt, but primarily equity. And they, in the private world, they get they start in the seed round, they get to round A, round B, round C, and eventually they participate till the company either IPOs and goes public or gets bought by a strategic or by a private equity firm. And venture debt does a great job of existing with the equity holders and provides an extra runway that that company needs to survive.
So it's actually providing the venture debt for a company that's also being funded by venture equity, if you will, or venture capital.
Absolutely, and it's really not meant to replace the equity. It's meant to extend the runway in order so that it's non-dilutive and you could reach the milestones accordingly.
Awesome. So for our viewers out there, before I forget to mention this, definitely drop in a comment, a question, anything that you'd like to ask Jay or myself. We'll be happy to at least attempt to answer the questions, right, Jay?
Absolutely.
And even if you just want to say hello, we're happy to say hi back. So just let us know if you have any questions as we continue to go forward. Christina Miller has loved the show already. Well, thank you. She happens to be my girlfriend, so that's kind of important. So I'm glad you're watching, Christina, and we're looking forward to hearing from some others. I'll keep you posted, Jay, as questions come in.
Okay, that's great.
So venture debt makes the other side of venture capital to help acquisitions or transactions get completed. What advantages does venture debt provide to companies versus selling equity in the company?
Well, no company really wants to dilute themselves if they don't have to, and especially founders when they're already giving a piece of equity to the venture equity investors. So what venture debt will do will provide extra runway so you can get to where you need to go and execute properly. And especially, let's say it also does very well in a publicly traded company. So let's say the market is affecting stocks as they have been for the past 6 weeks or so in this volatile marketplace, and a company needs to raise some extra capital. They can go to the venture debt market, which is generally populated by banks and by business development corporations or registered investment advisors. And a company won't have to dilute their stock. Their stock price won't take an impact necessarily. In fact, if anything, showing that a vote of confidence comes into play and it's able to absorb that debt may actually help the stock. So they, especially in biotech where companies may not produce for years, and the scientists can be heads down trying to cure cancer or many other opportunities, and they try to focus on the company doing what they need to do rather than focusing on what's in the bank and the stock price itself.
So I'm curious to know how are terms and interest rates determined in venture debt? What does that look like?
So in the current environment, I would say that it really is more of an IRR situation, investment rate of return, where in biotech, it's somewhere around the 12-13% region. And for tech companies, it's a slightly higher in the mid-teens area. That's the general market. And while it might, why am I saying an IRR instead of just a plain coupon like a mortgage? That's because there's origination fees and prepay fees, and that might come into play, and exit fees as well. So all in all, it's blended together to form an IRR, where that's what the general market is, those rates.
And just so everybody understands, exit fees mean that when they are looking to get out of the debt and exit from that debt facility, there could be additional fees to do so.
Right. Usually it could be to clean up the balance sheet, to go towards a transaction, to be taken private, or to be going public. It really depends on where that specific company is in their lifespan.
Got it. And so it almost sounds similar to hard money on commercial mortgages, for example. Rate wise, and what would the turnaround time for something like this be for a transaction?
So we've done things very quickly because we have some good relationships in place. But general rule of thumb is 10 to 12 weeks, soup to nuts, from interacting, signing an engagement letter, making introductions, and hammering out the terms, and then the documents that go in front of lawyers usually take about a month for everybody to go through everything with a fine-tooth comb.
A lot of reviewing going on.
A lot of reviewing.
So when I said it was similar to hard money, it seemed like you were going to mention something. Am I off base there, or is it
No,
pretty
I was
similar?
listening.
Oh,
I was just listening there.
I wasn't sure. So, it's like the equivalent of, because, hard money is there in similar situations on the commercial mortgage side. This is more for the business acquisition taking place, right?
Well, not only business acquisition can also provide. Let's say a company wants to expand and take over somebody, and they're private and they don't have access to funds. It can also provide, mix into their pool of capital and be
Hmm.
utilized for other things. Generally, venture debt doesn't. The non-bank venture debt, they don't restrict you how to use the funds. You use it as you see fit, and they're more interested in how it blends into your revenue and your EBITDA more than anything else.
And um, how does a company actually qualify for venture debt? What are you looking at in that?
Well, generally speaking, you would need a year's worth of runway. Venture debt usually is about a 4 year, 4.5 ish year term. Um, Minimum of a year of interest only, but there's all sorts of reasons that you might have to extend that, or they might want it to end up in a bullet at the end of a 3 or 5 year term. It really depends, but generally speaking, it's a year of interest only. And upon reaching the milestones, there's extra money that can be drawn down and extra time um, that can be extended on that interest only period. Not only that, about 90% of these terms of these loans never get paid back. They become a permanent part of the balance sheet, and they're recast, usually bigger if everybody's executing and doing everything that they should be doing.
Oh,
So
right.
so it can never dilute necessarily. Um, so it provides a really strong tool.
Interesting. So there's, I guess, renewals, but it doesn't have to be paid off at any specific time.
Well, it really depends. I mean, if something were to go, if you were to have a 2020 oh my god moment, there were situations where the companies had to watch their portfolios and extend interest only times because certain businesses were shut down, like elective surgery. There was no elective surgery,
Hmm.
so that you had to have you know uh, not material adverse change, things that we're very familiar with, but an oh my god moment that you make certain terms change a little bit in order for that the company is able to execute within reason when it's not at fault of the company or the marketplace, being in a pandemic, which hopefully we're getting out of soon, it feels like.
That'd be nice.
Yeah,
So the good news is, like you're saying, that there's flexibility. Okay,
absolutely. Yeah.
that's good. So does a volatile interest rate landscape and stock market help or hurt the ability to obtain venture debt?
So the answer to that question is both. You will have companies, you'll have portfolio managers, you'll have BDCs that are watching how the market is affecting their portfolio. And if too many of those companies are getting hurt, they won't lend to that, let's say that sector. Whereas other sectors might not be getting hurt and might be inflation friendly. They might go out and offer, be more readily able and opportunistic to lend to those companies. And the other side of that is there are some companies that have a fresh pool of funds. Let's say they opened up a third, fourth, or fifth fund and they must invest regardless. They still have to put that money to work. They're not paid to stay in cash, they're paid to find opportunities. So the terms will change somewhat, but I would say that while one door shuts, another door opens, and you just have to find it a little harder, you have to go a little deeper.
The interesting part for you then is that it doesn't matter which side the economy is on. It sounds like there's always opportunity,
There's
right?
always there's always opportunity, but I will say, if I had to lean, is it better in an up market or a down market? It's better in an up market. People sleep easier. But it is a useful tool in a down market when nobody wants to dilute their stock.
Got it. So what would you say is, I know you've been doing this how long? 3 decades? Is that what I
Well,
heard right?
I've been in different iterations of careers over the last 3 decades. Three
So
decades.
you started when you were 5, right?
Not quite.
Not quite.
But I did get licensed when I was 20.
Wow, that is pretty young.
That is young.
That's awesome. Yeah. So what's a typical profile for a company that's looking for obtaining venture debt?
Well, that they've so let's use tech as an example, that they've come up with a better widget, so to speak, and they really need to fill purchase orders and go faster and go harder. And they have their investors, and they've stayed with them through the good and the bad, and it's taken several years to go forward. And they're looking to raise another round, a Series B or perhaps a Series C. And the good thing about venture debt is it can coincide with that raise, so they can raise even more money, dilute the company's dilute the investor's ownership a little less, and still have the extra runway to go a little further, harder, faster, and there's comfort on both sides. The equity investors are comfortable because debt just came along and they've done their due diligence, and the debt guys feel like, well, these big equity guys have done their due diligence. So it's a very cohesive relationship.
Interesting. Okay. So we talked a little bit about this before the show. SPACs. We're not talking about specs that you wear for your eyes. Tell us a little bit about SPAC. What does it stand for?
So it's a special purpose acquisition corporation. There have been many that have been serial raisers of tons of money via SPAC. It's a blank check company. People have heard that term as well. And they generally are given 2 years to invest that money. Well, they were popularized in 2020 because everything was shut down. The SEC was slow to move everything, and it was easier to have a special purpose acquisition vehicle formed rather than the typical IPO process. So many companies needed cash quickly in an unknown environment, chose to go the SPAC route and go public, and some did very, very well for a long time. But unfortunately, they got saturated. Thousands of companies went public. They all went public at $10. When they de-SPAC'd, there was a certain unknown redemption situation where you didn't know how much you were really going to get in the end.
Wow.
And the large majority of these stocks have gone south. And here we are, where everything went public at 10. Stockholders have been burned. However, on the positive side, companies got funded at a time when they couldn't get funded. So they have the money that they need and the runway that they need. However, over time, and I'm not saying right now, since SPACs have really only been popularized the last 2 years, but they will come into play where a company won't want to sell their additional stock at 4 or 3 or 2 even, but yet because they have all the cash cushion, they might look to the venture debt market in order to borrow and complement their cash in order to reach the milestones that they're looking to reach.
So it was basically, it sounds like a alternative to venture debt in a time when venture debt might not have been as readily available because we were going through a pandemic and there was a lot of uncertainty.
Actually, I would say at the time, venture debt was still there and readily available. It was more to go public. You could not file the proper paperwork and go through the SEC blessing in order to go public. So that's why this vehicle was utilized. It's been around for decades. I've used them in the 90s and in many other ways. I've traded them then, and all of a sudden it felt like an old friend came back to visit, and the market just got very, very saturated with the product. But they're a great vehicle and they offer great opportunities, but too much of anything isn't good. We all love chocolate, but too much of that isn't good either.
Yeah, unfortunately. Wish it was. I'm waiting for that day when they come out and say it is, but
yeah, absolutely.
So, 3 decades doing this line of business. I always love to ask, what's the one transaction that sticks out the most in your mind, and why?
The one transaction that sticks out the most was a rumor actually happening. So it was rumored. This is going back to around 2007-ish. Hilton was. There were rumors that Hilton was going to go private, that there was going to be a takeover bid over the weekend, and it also was mentioned that that was on a Friday, but it was mentioned stock of the week on Thursday by Jefferies, value of the week. I'm like, well, it's value of the week, and it's getting all these rumors. Well, I bought some on Thursday. It continued to go up Friday. I sold some into the strength, and then after it got loud, these rumors got louder. I even sold into that because I've heard so many rumors. I believe none of them. And sure enough, that Monday it got taken over. I had a little bit left, no regrets, but because the likelihood of hitting a takeover is slim and none. But I was lucky enough to hit a little bit of it. So
you always find the bright side, even if they're the other side.
Yeah, I have no regrets. I don't believe there's a quick way to make money. I'm a slow and steady kind of guy.
Got it. It's awesome. So for the viewers out there, tell us, who are you looking for? Who's the ideal client, and how do we refer those folks over to you?
Oh, that'd be great. So we specialize mainly in tech and healthcare, but if you can put tech on the end of the company, we'll look at it. Climate tech's been hot. Battery tech, EV has been hot. Although they're very early in the process, we're looking in healthcare and biotech specifically. Look for companies that they're just getting going, have some good VC backing, and are they're in the clinic in phase 1 and looking to do what they need to do to get to phase 2. Mm-hmm. And on the tech side, that they're revenue producing, and that the optimal candidate is one that wasn't impacted so much during the pandemic, that was able to weather the storm of that, and maybe not as dependent. I mean, every company is dependent on supply chain issues, we're finding, but ones that prepared, that they were a bit of a squirrel and packed away some chips aside for future growth. Right. I mean, that's the optimal, that's the dream, but that's not reality. Nobody anticipated the supply chain problems that are affecting all of us, and including every time we go to a restaurant, how much is my bill? Yeah, we're all being impacted by that. Yeah. But still trying to look on the other side of it, looking forward rather than backwards, and looking what is budgeted forward, and to help a company help them optimize and reach their goals.
It's funny that you mentioned about restaurants, because I'm waiting for the time when I go to pay a bill and there's a line item that says supply chain out of order. Right? Unbelievable.
Yeah, it is pretty incredible.
Yeah, it just happened to me last night. I was like, whoa, shocker. I appreciate it. Hold on. John is asking, who are typical referral sources for you out there and that you work with?
Typical referral sources are companies that we've already placed. We've had it's very interesting in this sphere of young companies that management often leaves to go to other places. Sometimes to find help with the next company because they've done a great job. So it's usually within that company, from those companies, that we get referrals, but it's also being in the industry a long time. The lenders know us, and they rely on us, and they call up, hey, what's going on? What are you seeing? I have something for you if you're interested. So it's a combination of the two, both the lenders and other companies we worked for in the past.
Awesome. Very cool. I know we covered a lot of information. Is there anything that we may have left out that you wanted to add to the equation?
No, I just, welcome, to go looking forward past this pandemic where we can operate in a normal environment where the market's a little less volatile than it currently is due to the political nature of things, and we can focus on our lives and get back to a bit of normalcy. That I think we all can welcome that.
Absolutely. Yeah, I know that it's been a tough road up where you are, and hoping that things start loosening up a little bit more for you.
Yeah, it's gotten a bit looser. It's a little bit strange and surreal, but luckily I've avoided COVID. And it's not so much because I hibernate in my home. I do go out. I'm just very, very diligent about abiding by the rules, and
Awesome.
I've gotten lucky.
Yeah, and hopefully we'll get the lockout over with for baseball, and we'll start to get some of that coming around.
Wouldn't that be nice?
Yeah.
Wouldn't that be nice?
Well, Jay, I appreciate it. If anybody would like to reach you, your information is there at the bottom. It's Jay Spindel, J@INTE Securities.com, 917-597-2684. Reach out to Jay with any questions. If you would like anything that we can assist with, PharusGlobal.com is the way to find us. Jay, thank you very much for being with us tonight. Appreciate it.
Thanks for having me. Really appreciate it.
Yeah, absolutely. If anybody would like to be the next guest on the show, please don't hesitate to reach out, and you can find contact information again at PharusGlobal.com. Everybody have a great night. Thanks, Jay.
Take care. Thank you. Take care.